Imagine a company valued at a mind-boggling $47 billion, led by a charismatic founder who promised he could elevate the world's consciousness. Now, picture that same company, just a few weeks later, on the very brink of collapse. Its valuation is shattered, and its leader walks away with a nine-figure golden parachute while thousands of people lose their jobs. This isn't a movie script, it's the real story of WeWork. It's a tale of how pure charisma and relentless hype built a spectacular house of cards, and the shocking implosion that followed when people finally started looking a little closer. This is about a prophecy that was never real, a community that was just a commodity, and a financial disaster that became a brutal wake-up call for the entire startup world. Back in 2010, Adam Neumann, a towering, almost hypnotically charismatic entrepreneur, and his partner Miguel McKelvey launched what seemed like a simple idea. They'd lease huge office spaces, slap on a trendy millennial-friendly makeover, think exposed brick, kombucha on tap, and cool minimalist furniture, and then sublet small pieces to freelancers, startups, and even big corporations. Now, on paper, this sounds like a pretty standard real estate gig, right? Wrong. Adam wasn't selling office space. He was selling a revolution. He didn't talk about square footage. He talked about community. He didn't mention lease agreements. He spoke of a global movement to change the way we work. His employees weren't just staff. They were the we generation. And the company's official mission? It wasn't to make a profit. It was to elevate the world's consciousness. And for a while, the world absolutely bought it. The company grew at a dizzying pace. From one spot in New York Soho, WeWork exploded into a global behemoth with hundreds of locations all over the world. The offices were cool, the parties were legendary, and the energy was electric. Neumann was a master salesman, a cult-like figure who could make you believe anything. He walked barefoot in boardrooms, pour tequila shots at company meetings, and talk about becoming the world's first trillionaire, or even president of the world. People weren't just buying a desk. They felt like they were joining a movement led by a modern-day prophet. There was just one tiny problem. This whole vision was built on a foundation of sand. Neumann's intoxicating vision found its #1 fan in Masayoshi Son, the CEO of the Japanese investment giant SoftBank. Son, famous for making huge, risky bets on tech founders, saw Neumann as the next big thing. After a meeting that lasted only a few minutes, Son pledged billions. SoftBank's Vision Fund, a massive $100 billion investment fund, began pumping staggering amounts of cash into WeWork. In total, SoftBank would pour in over $10 billion. This fire hose of money didn't just fuel WeWork's insane expansion, it supercharged its valuation. In 2017, WeWork was valued at $20 billion. By January 2019, that number had swelled to an almost comical $47 billion. This valuation was the heart of the whole deception. WeWork was packaged as a tech company, a scalable platform that, like an Uber or an Airbnb, would disrupt everything. But it wasn't. It had no real technology. Its business model was painfully simple. Sign expensive long-term leases and then try to fill the space with short-term tenants. It was a classic high-risk real estate business. Yet investors, hypnotized by Neumann's charm and Son's money, gave it a valuation that dwarfed actual, profitable real estate giants. Masa's son would later admit his judgment was foolish and that he'd turned a blind eye to Neumann's very obvious flaws. But for a few wild years, the money kept flowing and the fantasy stayed alive. With billions in the bank, WeWork's spending and Neumann's personal behavior spun completely out of control. The company wasn't just losing money, it was burning it. Think about this. For every single dollar WeWork made, it was spending too. In 2018 alone, the company lost a staggering $1.9 billion on revenues of just $1.8 billion. This wasn't just investing in growth. It was a bonfire of cash. And the company's culture? It became a mirror of its founders' wild excesses. Neumann bought a $63 million Gulfstream G650 private jet for company travel, which he famously used for party trips with friends, allegedly while hotboxing the cabin with marijuana smoke mid-flight. He threw company money at bizarre side hustles like a wave pool company run by a pro surfer. Even more disturbing was the blatant self-dealing. Neumann would personally buy buildings and then lease them back to WeWork, making himself his own company's landlord. He took out huge personal loans from the company. But perhaps the most audacious move of all was when he had WeWork pay him $5.9 million for the rights to the word "we," a trademark that, of course, he had personally registered. He eventually gave the money back after a public outcry, but the message was clear. Lawsuits started popping up, alleging a toxic and discriminatory work environment. The party was getting way out of hand. This is the turning point, where the whole carefully crafted image starts to shatter under its own absurdity. It's a pattern we see again and again in the world of high-stakes startups. If you find these deep dives into corporate meltdowns as fascinating as we do, make sure to subscribe and hit that notification bell so you don't miss our next investigation. Then came August 2019, the moment of truth. WeWork filed for its IPO, meaning it had to finally open its books to the public. And what everyone saw was just shocking. The filing, called an S-1, laid bare the jaw-dropping losses, the tangled mess of debt, and Neumann's glaring conflicts of interest. The document was a financial horror show. Analysts and journalists ripped it to shreds. The company had invented its own profit metric called community-adjusted EBITDA, which hilariously excluded core business costs like rent, construction, and marketing, the things its business was actually based on. The filing also revealed that WeWork had long-term lease obligations of over $47 billion, a crushing mountain of debt for a company that was losing billions. The reaction was immediate and brutal. The emperor had no clothes. WeWork wasn't a tech unicorn. It was an over-leveraged real estate company being run like a personal piggy bank. The planned $47 billion IPO valuation was slashed to $20 billion, then to $10 billion, before the whole thing was humiliatingly canceled in September 2019. The house of cards had collapsed. The market had called their bluff hard. With the IPO dead and the company staring down bankruptcy, the board's hands were tied. Adam Neumann was forced to step down as CEO. But don't feel too bad for him. In one of the most controversial golden handshakes in modern history, SoftBank, in a desperate move to salvage its investment, negotiated an exit package for Neumann. While early reports floated a mind-bending $1.7 billion, the final renegotiated deal was closer to a still outrageous $445 million in cash and stock, on top of refinancing his personal debts and other perks. So while Neumann walked away a multimillionaire, the employees he once called his family got the short end of the stick. WeWork announced mass layoffs, ultimately firing thousands of people. Many of these employees, who had been paid in stock options that were now completely worthless, got little to no severance. The contrast was a painful picture of a system that rewarded the architect of a disaster while punishing everyone else. The grand promise to elevate the world's consciousness ended with pink slips and broken dreams. After Neumann was pushed out, WeWork began a long, painful downward spiral. A revolving door of new CEOs couldn't stop the financial bleeding. Then, the COVID-19 pandemic hit, emptying offices worldwide and gutting the entire co-working model. The company managed to go public in 2021 through a SPAC at a much lower $9 billion valuation, but the losses just kept piling up. And then, the inevitable. On November 6, 2023, WeWork, once valued higher than Ford, officially filed for Chapter 11 bankruptcy. It couldn't even pay its rent. In mid-2024, WeWork emerged from bankruptcy a private company after shedding over $4 billion in debt and ditching about 170 unprofitable locations. It still operates hundreds of locations, but it's a mere shadow of its former self. And in a final ironic twist, Adam Neumann, flush with cash from his exit, actually tried to buy the company back out of bankruptcy. His bid was rejected. Undeterred, he's now launched new ventures, including a real estate company named Flow. So, what does all this mean? The WeWork saga isn't just a wild business failure. It's a cautionary tale about our modern growth-at-all-costs culture. It's a world where a great story can be worth more than a great business, and where charismatic founders are handed billions of dollars with almost no oversight. Look, Adam Neumann didn't technically break the law, but he broke trust on a monumental scale. He sold a beautiful dream of community and revolution, but delivered a nightmare of debt and personal greed. And SoftBank, in its desperate hunt for the next tech messiah, was the willing accomplice that funded the whole charade. WeWork was never a tech company. It was a simple idea wrapped in a $47 billion illusion. When the hype died down and the easy money ran out, all that was left were empty desks and broken promises. It's a powerful reminder that charisma can't beat gravity, and a cult of personality isn't a business plan. Reality always sends the bill. So what do you think? In a world that's always hungry for the next big thing, have we really learned our lesson from WeWork? Or are we just waiting for the next charismatic founder to sell us another beautiful, expensive dream? Let me know your thoughts in the comments below.